a value investing strategy which claims to have returned investors 30% CAGR over 26 years. That means if you had put 1 lakh into the strategy and the stocks it says, you would have made more than 9 crore rupees. Well, that is a magic formula investment technique for you. And in this video, that is exactly what we're going to talk about. We'll see where this investing strategy came from. Then we'll discuss the rules of the strategy. We'll talk about backtesting and a few research papers to back the studies here. And then we'll talk about a screener, or I'll share the screener with you. And the last part where I'll be talking about 30 stocks that we found out using the screener and the formula, and we'll be sharing the companies with you as well. So yes, without further ado, let's get started. This is Ajay Ajith. Welcome to Market Feed. So let's start with the screen share here. Magic Formula Screener, that's what we're going to learn about today. So what is Magic Formula? It is a value investing based investment technique outlined by Joel Greenblatt. And who is he? He wrote a simple book which is called as The Little Book That Beats the Market. Imagine how much confidence that he had to write a book with that specific title. And looking at it, he is a professional asset manager since the 1980s who is currently managing an AUM of more than $6.3 billion. Yes, so he has a formula and he is a professional investment manager and he has a lot of AUM and apparently claims to have this high CAGR number as well. Don't worry, we'll get to that very soon. And yes, he presented this in the book title, The Little Book That Beats the Market. And he even wrote a follow-up book called as A Little Book That Still Beats the Market, right? 5 years later after the first book was announced or it was published. And yes, coming back to what is a magic formula, it is said to be a simplified version of the investment strategy used by Mr. Warren Buffett and Charlie Munger for their value investing approach, right? And yes, the author of the book has tried to make their investment strategy into a very simple set of 9 rules that you can follow. Right? So if that is the case, let's move ahead to why magic formula. So if you read the book, you'll understand that he wanted to simplify stock picking in a way that even a teenager will understand it. Right? That's the language of the book. It's very simple and very easy to understand comparing to a lot of other investment strategies. And Mr. Greenblatt also says this one famous quote, right? Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. And he says that you need such a formula, you need such an investment technique to pick out the right stocks in the market for the long term. So then without any delay, let's move ahead into the magic formula rules. He says that you should have a minimum market cap of greater than $50 million on any of the companies that you assess, right? Here, $50 million translates to 400 CR in Indian market cap today, but we'll be taking a market cap of more than 1000 CR to make sure that it accounts for inflation and the larger depreciation of rupee and the assets over the long term, right? So we'll be looking at companies over 1000 CR market cap only today. And then he talks about excluding utility and financial stocks. So he does not give a very proper reason here, but what we can assume is he did not want to look into companies which are very high or in very high debt industries. And the third rule is avoid international companies. In India, we have very few international companies listed. So again, we'll be following this rule as well. The fourth rule says that you have to determine the company's earnings yield. It is nothing but earnings per share divided by the current share price, or you can find it using this formula as well. EBIT divided by enterprise value. What it is trying to find is the earnings capacity of the company. How well is it managing profits, or what is its capacity in making profits? That is what we are trying to understand with the earnings yield formula. The fifth rule is trying to bring out the company's earning potential, comparing it to the capital that it has deployed into its business. So here, a lot of things will be coming out without you even knowing about it. For example, a company's hundreds or multiple decades of marketing work and its brand value that it has created over all those years, stuff like that will come out here. Let's take a company like Coca-Cola, which can make larger profits by deploying smaller amounts of cash. Why? Because of its decades-long moat it has created. Again, do remember that this strategy or this rules and framework, it is trying to bring out or simplify Mr. Warren Buffett's investment strategy in itself. right? If that is clear, let's go ahead into the next point, which is ranking all companies by the highest earning yield and the highest return on capital. So in points 4 and 5, we understood the company's earning yield and we understood the return on capital as well. So based on this, we have to rank a company. How? I'll show you very simply in the next segment of the video. But after that comes the next biggest thing, which is investing in the top 20 to 30 companies, which you get from that list. Right? So it's very, very easy. Basically, you have to do a simple screen of things. And after that, you'll get a lot of companies. Let's say you'll get 200, 300 companies. You have to rank them. And based on their rankings, whichever company is superior, you have to think about investing into them. And in his second book, he introduced a small tweak to this 7th point, which is he said that invest in the top 20 to 30 companies which have a price to earnings ratio of greater than 5. He said that basically this simple rule will make sure that you weed out very low quality or very cheap companies which are having weird earnings reports, right? And we'll be doing that or including that in the formula as well. Now you found out the companies, but then the question still arises, when do you invest into these companies and when do you exit them? For that, he looked at 2 different rules, or he introduced 2 new rules here. So one says, the 8th rule says that you have to rebalance your portfolio once per year. And in that, he introduced a very particular rule. It says that basically, if you're trying to invest for the long term, right, any investment which is under 52 weeks or under 1 year comes under short-term capital gains, and any losses there, right? Any losses in your portfolio companies, you should try to sell them off in your 51st week of investment. And what does that bring out? It will weed out all the loss-making stocks and it will make sure that these losses are contained in your short-term capital losses. And you can accumulate your short-term capital losses and you can set it off with other business expenses or business profits here in India if you're a serious investor. And above this 52 weeks, it will all come under long-term capital gains and you'll be enjoying a lower tax rate on your profitable investments. And the 9th rule is very simple. You have to keep on doing or implementing this strategy over a very, very long time frame. He says that over a 5 to 10 year long time frame. And that is what the 9 rules of this simple investment strategy are. So if that is clear, let's go ahead and look at the back test of the strategy. See if it is valid in the US market, if it has been making money, and if it is valid in the Indian market as well. Multiple studies have been conducted all over the world, and basically all of them found out that under ideal conditions, under conditions when the market is not in a bearish phase, this strategy works out beautifully and it beats the market averages. And I'll link all the detailed research papers in the description down below so that you can check out all of them. But one we'll be highlighting is the Indian study that was conducted. And for the Indian context, a study was conducted in 2022 by professors at the University of Delhi, and it was found out that while the BSE Sensex gave a return of nearly 9.8%, Mr. Greenblatt's magic formula has returned more than 13% CAGR over a time frame between July 2012 and 2020, right after the COVID crash. So you can see that over all of these years, the magic formula has stayed relevant in the Indian market, and the study is a simple proof of it. But let's go ahead and get into the screener for the next part of the video. Coming into the screener part, we're going to use the tool screener.in, right, which we've used for multiple of our previous videos as well. Again, this is not a paid endorsement of the product. In fact, if you look throughout the entire channel's history, we do not promote any such platforms at all. So make sure you get subscribed if you like that ideology. And this video is not investment advice. It is just presenting a strategy in front of you which apparently works using all the historical studies that we have provided, and it is upon you to make sure that you do the right research before you invest in any of these companies. So again, going into the rules here. So first, we are going to give a market capitalization of greater than 1000 crores, and we are also going to give a simple rule here which says that return on investment capital or invested capital is greater than 25. So what can you see here? A lot of companies came in, right? Nearly 291 companies came in with different market caps and different ROICs and everything. Right? So what do we have to do here? We have to copy paste all of these into an Excel sheet so that we can continue our further analysis and start to rank them. So yes, this is that Excel sheet right here. Do not worry, I'll be sharing this Excel sheet in the description down below as well as in the pinned comment of the video. So what have we done here? First, we have taken the ROIC, which is the return on capital, right? And we have tried to rank that. And after that, we have also looked at the earnings yield of the company and we'll try to rank that as well. So here, first we'll be doing a ranking of ROIC. So it's using a very simple formula. Basically, you'll be giving a rank function and you'll be getting a number here. So you can see that Nucleus Software, again, not an investment advice, Nucleus Software has a rank of 8 under ROIC. That means it has the 8th largest ROIC in this group. Similarly, we'll be doing a ranking of the earnings yield as well. So you can see that the company here has a rank of earnings yield. It is a 65th largest earnings yield company out of our total list. And the screener says that after doing this individual rankings, you have to take a sum of the ranks and then you have to rank that sum again so that you get all the stocks in the order of the highest earnings yield as well as the highest ROIC. Again, this poses a very straightforward disadvantage here. You can see that in the case of Nucleus Software, it has a very high return on capital, but it has a relatively lower earnings yield, right? That is a disadvantage of the strategy, but it is believed that using this technique, it will get the average of both and you will be ending up with only good companies here. And after doing the ranking, we have put in the last minute modification as well, which is the PE ratio should be greater than 5. It will help us weed out all the very low quality stocks in our list. So the rule says that after you've done all the screening and this ranking, you have to go ahead and invest into or think about investing into the 30 largest companies here or the 30 highest ranked companies here. Which are they? Just to give perspective, there are very small companies with smaller market caps like Nucleus Software, but there are also very large companies like ONGC as well as TCS, BPCL, all of that companies as well. So yes, then the next step is only to do a deep dive research of all of these companies. And the only thing that I would suggest here is after this deep dive research, try to weed out any shady companies, right? I would say just follow the formula in its essence, but try to weed out very shady companies. For example, there was a recent company, if we ignore the PE rule, right? If we ignore the PE rule, there is a company which comes up here on the very top, right? Which is called as Mishtan Foods, right? But if you look deeper into the company, you can understand that mostly, at least that is an opinion which you can see in the internet, right? So try to weed out all these very shady companies. Then you can think about investing into them with equal weightages. And after that comes the 8th and 9th rule which we discussed, which is first you have to rebalance this stock portfolio every single year. And after that, you have to think about investing or using this strategy for a period of 5 to 10 years. So yes, that's the strategy and the rules and the 30 stocks in its core, right? I'll be sharing this formula and this sheet in the description down below as well. So again, coming into the cons of the strategy, few disadvantages that I saw about. One, the first thing is it simply does not give the returns that Mr. Joel was promising in his book, which is 30% CAGR. That is a crazy number which I don't think is replicatable, at least in the long term in India right now. Now the second disadvantage, there are certain companies, for example IST here, which you'll have to do deeper studies about because it's basically a very small market cap company and the results, earnings reports, its annual reports, everything might be a little more difficult to understand than a, let's say, an ONGC or even a TCS. So that's those companies you'll have to do a slightly deeper study about. And the third disadvantage which we found out about from all the research papers and backtesting is that this formula tends to outperform the index in good years, but in bad years, right, it can dip below the index returns as well. So let's assume that next year Nifty might be going for a big crash, right? This formula might give you slightly lesser returns or underperform the index in that way. But over the long term, it makes up for it and gives you higher CAGR as compared to the index. So short-term volatility and long-term gains. So yes, that's it about the formula here. It's a very simple investment strategy and I'll be surely looking into it and making sure that I'll be looking at each and every company for the long term. If you like the video, make sure you hit the like button and you get subscribed as well. This is Ajay Ajith signing off. See you all again. Bye bye.